Over the last few years, inflation, the rising cost of living, standing wages, and seemingly unattainable housing prices have created a perfect storm of financial stress worldwide, including for many Canadians. These pressures have sparked a growing wave of financial anxiety for many. This has led many to question whether traditional financial advice still applies or if planning for the future is even worthwhile. But despite these challenges, it's crucial to remember that thoughtful steps and an understanding of how markets work can help you build a more positive outlook toward your finances. We're now joined by Brendan Caldwell, Director of Caldwell Securities Limited, to discuss how to take the stress out of investing. Brendan, thanks for joining me today.
Well, thank you. Glad to be here, Theresa. I don't know how we're going to take the stress entirely out of it, but we can maybe shift a little place or somewhere just to move it to the side just a little bit.
Well, talking about it is a start. So, in times of market volatility, what strategies do you use to evaluate or select stocks for investment?
Well, there's probably a better analogy, but you want to have the dynamite in place before the train goes over the bridge. Before the thing that's supposed to happen happens, and eventually, there's always going to be a something. There's going to be a COVID crisis, or there will be a financial crisis, or there will be a tariff crisis as we're going through right now. There's always going to be a crisis. So, in times of uncertainty, all times are uncertain. We have no idea what today holds, let alone tomorrow. But what we try and do in advance of the crisis is to own stocks that have at their fundamental core good, what we consider to be value characteristics, that they have low debt, that they have increasing sales, that the overall economic picture for that particular industry looks good. So there's a whole bunch of factors we consider rather than just what's hot. So it's tended to have been in this market correction that's really begun since the beginning of the year and accelerated through the announcement of the tariffs. It's really been the stocks that were, for want of a better term, hot, the Magnificent Seven, so-called, the tech stocks that had really driven the market on the upside to the point where their valuations no longer made sense, that have led the market back down. Most other companies have not been hit nearly as hard.
And in uncertain times, is it safer for investors to stay in cash, or are there compelling buying opportunities here?
It depends what you mean by safer. If it means reduced anxiety in the short term that your investments haven't gone down, then yeah, probably cash is safer, probably. But your preamble was that the stress that people feel was around how to plan for the future and whether planning was even worth it and whether traditional mechanisms were effective or not. I think that one has to have a strategy for all times. Now, I think for most young people, who I think those comments were largely directed at, by far the best, and if we've talked about it once, we've talked about it 100 times, to the point I must be boring your viewers and you, that younger people should have a monthly contribution plan where they're adding a little bit, with just slightly what they can't afford, whether it's $100, $300, $500, $1,000 a month, whatever they would notice, to some sort of growth investment. Usually I would suggest a mutual fund because they're really set up to take those periodic smaller investments. But an investment that can grow, and if it goes down, so be it. If you're adding a little bit every month, the advantage of dollar cost averaging, which is a very old investment principle indeed, the fact that you'll be buying more when the thing is lower and less when it's higher, that will stand people in good stead. Now, coming into a crisis like the one we're in at this moment, or at least people view it as a crisis, the tariff crisis, having a bit of a strategy going into it's not a bad thing. I don't know if we've seen the bottom of the market. Today's trading has been all over the place, with the market being down considerably and then up and then down again. But whether today is the bottom, whether tomorrow or next week is the bottom, it's not going to long-term matter, because if you look back at all the other crises of the last 50 years in the markets, they all look like little blips with the benefit of time. the COVID crisis, the financial crisis, the bear market of 1974 all look insignificant by comparison. So the question is, how do you deploy capital? And I would suggest to people that if you have some money to invest, if it's say $25,000, invest five of it today, tomorrow, in whatever the market's doing. If the stocks that you wanted to own at 3 times their current price, buy a little bit of it today. And if you end up getting a chance to get it cheaper tomorrow, so be it. Because you'll be able to see a year or 2 or 3 from now that this will look like a blip as it fades into the rearview mirror.
And have you had clients call you in a panic during times of market uncertainty? And what advice do you typically offer them if it's different than what you just previously mentioned?
What I don't generally do is talk them out of it. I am not so arrogant as to think that I'm always going to be right. And if a client's calling and saying, sell, get me out, do it now, I will do it. My views are well known. My clients get all these videos and the writings that I have about the markets. They know that I think differently. But if they have, through a considered view or, to your point, an emotional reaction to the market and think it's going to get worse before it gets better and they want to be in cash, I don't stop them. If they want my opinion on it, then I would talk about, well, what cash do you need in the foreseeable future, this week, this year, and maybe look to raise that much cash. So if it does get worse, we're not selling when things are even lower, but we've set aside enough cash. But I would suggest to people, again, a strategy going into a crisis situation, having the dynamite in place, so to speak, have a bit of cash set aside so that when a crisis does come, you have the ability to capitalize on an opportunity or to avert whatever cash flow crunch you're going through.
Now, yesterday on Air Force One, Donald Trump stated that he isn't concerned about market losses. What do you make of that, and should he be concerned?
Well, I'd be concerned that the people advising him might have, like Howard Lutnick is historically in the bond business, and that he might have been long the bond market going into this, that the people around him might have had a vested interest in this. Probably not Elon Musk, as he's seen his value of his Tesla stock fall by, well, some very large percentage. The President of the United States says a lot of things, doesn't he? Some of them he believes to be true.
And when is the best time to start investing?
Well, as they say, the best time to start planting a tree was 20 years ago. The second best time is today. And I think today, of all things, if you've never invested in the market before, don't mortgage the house to do it today. But if you've never invested in the market before and you have money in GICs or under your mattress or whatever, take a little bit and start investing today. And then some maybe next month. So doing a little bit at a time, I think, will land people in very good stead.
Well, Brendan, thank you so much for the time today. We appreciate it.
Thank you, Theresa.
Don't go anywhere. We'll have more of today's top national and international headlines right after the break.